Hi, everybody. Well, I'm welcoming our friend Larry from Guaranteed Rate Back. It's time to talk about interest rates, Larry. I mean, it's a changing world out there. And I think that it's nice to have a resident expert who can give us some ideas and answer some questions. So in talking through the issue, everybody hears on the news to say, if we're going to stop a recession, interest rates need to go up. Is that true in your opinion?
No, it's not. I don't think that's entirely accurate. We've got some conflicting market conditions going on right now, and everybody sees the Fed raising the short-term funds rate, and I think they think that's the government's effort to stave off a recession. And they're actually doing that to try and bring inflation down. So that's a typical fix for that issue, and that's why you've seen the Fed raising the Fed funds rate here in recent weeks. But that is not the fix for recession concerns. So the Fed funds rate, a lot of people get confused and think that's the same as mortgage rates. It's actually not. The Fed funds rate is the rate at which banks can borrow money from each other. But people think it's, when they hear, oh, the Fed raised rates, they think they're talking about mortgage rates. It's not the same thing. Increasing the Fed funds rate can impact mortgage rates, but I've seen it go both ways historically. There are times when the Fed makes that announcement and mortgage rates go up, but there are other times when rates actually come down. Now, even though overall we're in a market right now where rates have been going up, after the Fed made that announcement about the 0.75% hike on the short-term funds rate, mortgage rates actually went down the next 3 days after that. So the media, however, was painting a gloom and doom picture. Oh gosh, this is just gonna kill the market and real estate's gonna crash, and so no, the solution for staving off a recession is actually lowering interest rates. That's why I say we've got conflicting conditions right now. The way to fix inflation, supposedly, is to raise rates, but the recommended solution for staving off a recession is lowering interest rates. So which one do we want to fix?
Well, and there's not a whole lot of control that the average American has over that. So, you're kind of stuck with it. So people are out there saying, well, Larry, I clearly can see that rates are higher than they were last year. That's a fair statement, right?
Yes.
So how does that impact the real estate sales, and what should you do, or what should you be looking for?
It's going to have a significant impact. And I think we've already seen it, for the buyers, the higher rates, mean that they may not qualify for the price range, that they were hoping for. And many of them, their concern is staying in a specific geographic area, a specific school district. And now they no longer qualify for that price range. And in some cases, they don't qualify for mortgage financing at all. One of the things we've been doing here recently is looping back to a lot of the clients that we pre-approved several months ago and revising their numbers, updating their pre-approvals. And in some cases, we've had to deliver, bad news that, well, we can't target this price range anymore. Or in some cases, they don't qualify at all for financing. And the rates are impacting the potential sellers as well. I think it's one of the reasons we have so little inventory on the market. Some potential sellers are deciding not to list their homes, especially if their plan is to buy another home after their current home sells.
Sure, and I think people's hope is to do something better, so they're even going to be in more debt then, right?
Exactly. So they're facing a double whammy,
right?
The interest rate on their new mortgage may be double what the rate was on their current loan, and prices, values of homes have gone up to boot. So while the idea of getting a great price, for their current home is attractive, the cost of the new one maybe not so attractive.
Right. And right, the cost from two perspectives. One is the increased price overall and the other is the increased interest. So you get double
Exactly.
hit. That's what you're
So when you
explaining.
combine the two and you look at what the monthly payment is going to be, I always talk about two things: affordability and monthly cash flow. So in a circumstance like that, their affordability and specifically their cash flow is going to change, in some cases dramatically.
So
And
then would it be fair to
well,
say that you're seeing some maybe delays in people even wanting to list their property for sale in this environment?
yes, I think that's been a contributing factor. I think the fear of not being able to buy that next house with so little inventory on the market. There are those folks who are not seeing anything they like,
Right.
but then they're also worried about being outbid. We've had just a crazy year this year with people, we call it bidding over, offering $30,000-$40,000 above asking price. And so even if the client finds that new home that they really like, they may not have the winning offer. And so that fear of selling, because on the seller's sides, they're not going to accept contingent offers. A contingent offer is a way for you to sell your current home, and you don't have to do that. And you don't have to do that until you can. You don't have to close on the purchase of the new house until you've got a guarantee of selling your old home. That protection is gone now. And so you take the risk of selling your current home and not being able to get the next house.
Right. And if you're not able to get it, you're looking at rentals, and look what's happening in the rental property arena as well.
Exactly. The rental market's just crazy. And not everybody has a relative that they can move in with,
or that they want to live with. Let's just all be
yeah, that's true,
right.
too. Yes.
Yeah.
Yeah. And so it's a challenging market. And all of those things have contributed to the lack of inventory that we're seeing out there.
Sure. And I think a lot of people then are just taking the environment, let's hold tight and see what happens. And they have alternatives. For example, they could upgrade their current home, correct?
Exactly. We've seen this, with the previous housing crisis that we had in 08, 09, where, and then we had rates going up. So people said, gosh, if our reason for selling our current home and buying the new one is we needed a little bit more space, an extra bedroom, or maybe we just, we wanted a nicer kitchen or whatever, people decided, what, we'll stay where we're at, have the nice low interest rate on that main mortgage, and then go take out a home equity line of credit to remodel the kitchen or add that room addition or finish the basement. And there was a window of time where that was happening a lot. And we may be moving into that kind of market now with the sellers hesitant to put their homes on the market. They may just decide to, if they have a lot of, especially with the huge increase in values here in the last year, there's a lot of extra equity in the house now. They can take a little bit of money out by way of a HELOC and then do remodeling or add that room addition. I've had people calling me to do cash out refis for that purpose. They wanted to take money out to upgrade their homes. And I said, gosh, if your current mortgage rate is, 3.25 or, 3.5, a cash out refi comes with higher interest rates than even a rate and term refi. So I look at it and say, gosh, if you do a cash out and you have a current mortgage balance of $200,000 and you want another $20,000 out to remodel the kitchen, if you do a cash out refi, you're now increasing the interest rate on the entire amount that you owe. $220,000 is now at a 6.5% interest rate. Instead, just leave the current mortgage where it is at 3.25 or 3%. Take out a HELOC. It's going to have a little bit higher interest rate, but that higher interest rate's only on 20,000, not 220,000.
Right.
So I tell people that all the time, and they say, well, let me get this straight. You don't want to do a cash out refi for me? And I say, no, I don't think it makes financial sense for you. This, I think, is a better option for you.
Yeah, I mean,
So
from your perspective, it might be easier or it might be to your advantage to do that, but you're going to give them an honest answer and tell them this is what it looks like. And you really have to factor that in.
unfortunately, there are those mortgage folks out there who they want to do the cash out refi because that's what they get paid on.
Right.
It's a percentage of the total loan amount. So they're not interested in doing a $20,000 HELOC. They're interested in doing the $220,000 cash out refi. But that's not who I am.
No,
I like
and
to
that's
sleep at night
why,
and feel good about what I do. So,
right. And that's why we invite you to participate in this,
well,
because
thank you.
it's really important for people to see that and really look at what all your options are, because we live in a here and now society. I want it today. I want to close tomorrow. And that's just what I want. And sometimes that delay factor or looking at all your options here might be a better choice. And you really have to
Yes.
look at that in the future. Just because you can get a loan to buy something doesn't mean it's a good idea to do something.
That's right. Doesn't mean you should do it.
That's
But you're
right.
right. I call that instant gratification.
Yes, and exactly. And I think that our message today to people is, look, interest rates are changing and you really have to consider what is in your best interest for your family situation that's there.
Yes.
Now, I know you don't have a crystal ball, but do you expect or anticipate that interest rates will continue to rise?
I do, but there's, in my opinion, good news on the horizon. So,
What's that good news for everyone?
so the short term is yes, I do think rates will continue to rise. However, within I think the next several months, we're going to see rates coming down. I think we are, excuse me, I'm sorry. I think we are headed for a recession. And if we look at it from a historical perspective, every time in the past, going back to 1960, we've had 8 recessions. Every time we've gone into a recession, mortgage rates have come down. And I think that's what's going to happen this time around. And this is why I think that during a recession, excuse me, bonds are seen as a safer investment. It's considered to be a more conservative and a safer place for your money. So in a recession, people move their money out of riskier investments like stocks and put their money into bonds instead, including mortgage-backed securities, which are also known as mortgage bonds. So when money flows into bonds, mortgage rates usually come down. So if we do, and the unfortunate part of it is, well, we end up in a recession, but
Right.
if there's light at the end of the tunnel or some, the good news, bad news, the good news is I think rates will come down. And, we've had the GDP numbers for the last 2 quarters, which has historically been used as the benchmark for determining if we're in a recession or not. And those numbers suggest that we are. So that's why I say that even if they stall any official announcement of a recession, I think within the next several months, it's going to be clear that we are in one. And then I think we're going to see the market adjust, and I think we're going to see rates come down.
It's interesting. In the interim period of time, do you think that the rate increase has any impact on inventory? How can you correlate the two? Because clearly there's a very limited inventory.
Yes, and I think it comes back to a topic we touched on. I think sellers are very hesitant to put their homes on the market. One, for fear of not being able to get that next house. But then 2, when they do the math, their current mortgage, may be in the high 2s or the low 3s. And then they look at, well, gosh, if we sell this house and we buy our next one, our rate may be double what we have now. And is that really affordable for us? Plus the increased home values means a higher purchase price. So the combination of higher purchase price and higher interest rate, I always talk about monthly cash flow and affordability. And I think lots of homeowners are doing that math and saying, gosh, I don't know that we can afford to do that move up buy.
Right. What about renting versus buying, in your opinion, in this environment? You got a young person out there, they're starting their first job. What's the time? Rents are high, but now we have interest rates and other issues and house prices.
We sure do, an interesting combination of factors, but I still always think it's better to own than to rent. And I'll tell you why. I can understand why some people would be considering renting right now, with the challenging market conditions we have, lack of inventory out there. I could see why some people are considering renting. But there are some key factors that I think they need to take into consideration before they make a decision to rent. Most industry experts are predicting that home values are going to continue to appreciate in the foreseeable future. Meanwhile, rents, on the other hand, are forecasted to rise by more than 5% per year. And that, again, coming back to affordability and monthly cash flow. In fact, the largest landlord in the United States said that rents went up 14% in the past year. 14%. That's a huge number. And they're predicting that they're going to grow up on average about 6% annually going forward. So, for example, using just that 5% annual number over a 5-year period, your rent could go up 25%. With a mortgage payment, the principal and interest portion of your payment will never go up because it's locked in. You can still have an increase in your property taxes, maybe your homeowner's insurance, but essentially from a budgeting standpoint, you have a mortgage, what that payment's going to be long term. With rent, it's a wide open field right now. Plus, your mortgage is going to amortize, and meaning that a portion of each of your monthly payments goes towards reducing your loan balance, which builds equity and wealth for the homeowner. So, for someone owning a home, it can create significant wealth for their family. This is much different than paying rent, which builds wealth for your landlord.
Sure. No, and I understand that. And you said something about house prices going up and that people think that the housing market will continue to go up. What do you say to the person, though, that's lowering the prices or seeing their home values going down right now? I mean, I think in the last couple of months in many places, you're seeing for the first time in a very long time, people taking a reduction in what they were asking, where before we were overbidding.
Yes, as little as 3 months ago, we were overbidding.
Right.
And now we're not seeing that. It kind of comes into a supply and demand concept. We had tons of buyers out there earlier in the year, but lack of inventory. Well, guess what? The buyers all got frustrated, and I call it sitting on the fence. They've all decided to sit on the sidelines and maybe wait till next year. So now there isn't the demand that we were seeing as frequently as June.
Right.
And so the sellers are saying, gosh, I don't have, in March, April, I had clients that they were getting 30 or 40 offers on their home. I mean, it's just a crazy number, and bidding, $40,000 over asking price. It's interesting how quickly those conditions shifted. And now the buyers aren't out there, and they might get an offer or two. There are homes now that have been on the market for 60 days. Which
really was normal before.
Yeah,
right.
You're right.
I mean, that really was normal. Now, then it got over the top, and now, as somebody, I read an article the other day saying, "Don't panic. This is what original normal was."
That's right.
I thought that was a really good analysis. You can't think that it's
exactly right. Sellers got really spoiled here in the last year, where they put their house on the market on Thursday. Seems to be the favored day for real estate agents to put a house on the market, and by Saturday it'd be under contract. And they had multiple offers to choose from, and now within the last couple months, because of those conditions, buyers got frustrated and left the marketplace, and you're right, now we're back to what is normal most of the time.
Right. Well, and practicing in the area of family law, obviously this has an impact on it as well. I mean, people are maybe thinking, I'm not so sure this is the time, even though I don't see our relationship going anywhere. They can wait it out unless there's really a good reason, or there's a problem, or there's something that's occurred that really sparks the need for the divorce. It'll be very interesting to me to see what happens. Although, in my experience, and I've been practicing family law for over 33 years now, whenever the economy gets bad, right before we seem to slow down. And as soon as it hits rock bottom, we seem to go up quickly. It's very strange. And I would like to do a study about that. And I'd be curious to hear what your observations are about how this impacts divorce.
And I think you touched on it. Yeah, I think, the typical person looks at it and says, gosh, the conditions right now are really not ideal. If we have to move forward, we will. But, the previous recession just several years ago, what I saw was, couples deciding to wait it out. Hey, let's not finalize the divorce. Let's not force ourselves into a situation where we have to, do mortgage financing if the conditions aren't good for it. So, that couple that, one spouse, one spouse may be looking at retaining the marital home and then refinancing the mortgage to remove the other spouse from the title and mortgage, and maybe also taking equity out to pay the spouse their share of the equity. They may be looking at it and saying, gosh, this is not the time to be doing that. We have a 3% interest rate now. We have to do a refi. We're going to double the interest rate. On top of that, it's only one spouse qualifying for the mortgage now instead of two spouses and double income. So they might say, gosh, we don't have to remove the other spouse right now. Let's wait until market conditions are better to do that. And then similarly, if both spouses are going to go and buy their own homes individually, separately, the same challenges, higher interest rates, half the income, low inventory right now. Yeah. So, a lot of folks are going to make the decision to let's just hang on. And let's
hang on or be creative, right? Be creative with your family law attorney and figure out what options, because there can be some options with that as well. It's amazing to me, Larry, that this has just been a few short months since we last had a conversation, and our conversation is, in some regards, completely different, right?
It is.
Yeah, and it's fascinating to see. So I would love to have you back as we're going through this. And, if we do hit that official title, although I would agree with you that there's definitions of recession and we're probably already in it, but what impact that would have, because I do think that this is an ever evolving issue. And I don't think that we're leaving today answering people's questions concretely, because there really isn't a great answer.
Yeah, there's no right or wrong answer. It all depends on that person's needs. Maybe they really need to buy now, or maybe renting is a temporary solution. I know that there are folks out there, for example, that are being counseled. Well, you know what? Rather than retaining the marital home and refinancing the mortgage, sell while prices are possibly at their peak. There are those folks who seem to think, we're going to see some price correction, market correction here. Right. So sell high and buy low, that old concept. So that might be a strategy to employ. No one has a crystal ball. We don't know.
That's exactly it.
Bring. I mean, look at, like you just said, look at where we were, from a conversation standpoint a few months ago, where we are today.
Right.
So there's no right or wrong answer. You just try to make the best decision you can for yourself based on the information that's available to you.
That's
and
correct.
Every person is going to be different in terms of which route they decide to go.
And I don't want people to listen and feel depressed or anything. This is normal. This market adjustment. I mean, these are things, you've been in the business for a lot of years. You know that this happens. We go with the ups and the downs and the flows, and there's good on one hand and bad on another. And you're right. There's not a right or wrong answer. It's just the concept of time.
Yes, exactly. And people, on a separate note, people say, well, gosh, rates are so high. Well, I like to look at a historical perspective. When you look back to the 80s or the 90s, rates were 14 to 18%.
Right. They're not high. Right.
Points to get that rate.
Yeah.
Now, even though rates have gone up a little bit in the last couple of months, they're still in the fives, Right. So compared to 18%, I'll take 5 all day long.
Absolutely. Right. And again, it's that perspective, it's age, it's a lot of different things that are out there for people. And I think it's good for them. If you're going through a divorce, you certainly can reach out to us. If you are looking at, any kind of advice that's needed with regard to financing, whether you should refi now, get a home equity. Larry can help answer those questions and, lay it out and give you truthful, here's the analysis. Now you choose, right?
Yes, exactly. I always talk about being able to make informed decisions.
Right.
I always say the path forward becomes clear when you have all the numbers in front of you.
Right.
And, certain routes make sense and certain avenues don't. But what we try to help the clients with is to figure out what makes financial sense and what doesn't.
Right.
And then they can move forward accordingly. Otherwise it's guesswork. Well, I think maybe we could, so no, let's get the numbers and let's know for sure.
Right.
And then, make an informed decision.
Informed decision is the best way. And our motto is empower yourself with options, because that really is what you have to do. You have options. And there are so many of them as we sit here, and it really is choosing what's best for you. And look, we've all made mistakes. I'm the first one to say, I can tell you different things that I did over my lifetime that maybe weren't the best decision but at the time that was the decision that had to be made. You can't change that now. You can't go backwards. And Larry, I'm sure your life experience has been the same, but you do the best you can at the given time with the facts you have.
Yeah, exactly. You figure out what the best solution is for right now. Can't worry about what happened in the past or change anything that happened in the past.
Right.
That's history. It's over. Let's figure out where we go from here.
Right. And if you got into a mortgage situation and you're at 6% and the rates go down to 4.5 or 4, you could refinance at that point in time.
Absolutely. One of the things that we do is we call it managing your mortgage. I don't do financing for someone and then forget about them. I continue to watch the market. And then if I see a window of opportunity where someone could potentially refi and lower their rate to a point where it makes financial sense, I reach out to the client and say, hey, market conditions are such and such. I think this might be a window of time for you to do a refi if you want to. Here's what the numbers would look like. I show them how to calculate whether a refinance makes financial sense for them. Here's the math. And if it does, great. And you want to move forward, be happy to help you. But there are times when it doesn't make sense, and I'll tell them that too. But I do watch the market for all of my clients, and I watch for windows of opportunity where they could potentially refi. And I'm glad you brought that up, because depending on recession and historical perspective and rates coming down, we might find ourselves in a market like that within a few months where rates are starting to look really good again. And so there may be an opportunity for people to do a refi, and the purchase market may change as well. And
the bottom line, and I think the closing point is don't bury your head in the sand, just saying I'm stuck. It's something that is just like our conversation has evolved the last couple of months, and it will evolve in the next 3 or 4 months. We know that already. Consumers have to also make themselves aware to look at their options and making sure that they're considering what it is and that it's a moving target. So that's really, I think, our concluding factor for today, Larry, is that people need to pay attention to it. Don't push this under the carpet, deal with this issue head on, and know that you have options available to you.
Yes. Yeah.
Thank you so much. We really appreciate your time, and we'll talk again in a few months.
Sounds good. Thank you. Right? Thank you so much for having me. I appreciate it.
Take care.
You too.